It's a brand new week and we're glad to have you on Business Morning. Good morning, I am Bisi Adebayo. Let's kick off with the latest from the crude oil markets where prices are down more than 1% today, and that's after earlier hitting their lowest since July. And this comes as Saudi Arabia made the deepest monthly price cuts for supply to Asia in 5 months, while optimism about demand recovery cooled amid the coronavirus pandemic. Brent crude was at $42.18 a barrel after earlier sliding to the lowest since July the 30th. US WTI crude was also down to $39.26 a barrel after earlier dropping to the lowest since July the 10th. The world remains awash with crude and fuel despite supply cuts by OPEC Plus and government efforts to stimulate the global economy and oil demand. Refiners have reduced their fuel output as a result, causing oil producers such as Saudi Arabia to cut prices to offset the falling crude demand. Oil is also under pressure as U.S. companies increase their drilling for a new supply after the recent recovery in oil prices. And back home, the central bank will today resume the sale of foreign exchange to bureau de change operators nationwide in a move that is expected to further strengthen the exchange rate of the naira. The regulator had issued a notice earlier stating plans to resume the bi-weekly sale of $10,000 per operator from today. At the parallel market last week, the naira closed at around 430 naira to a dollar compared to 480 a week earlier. This also follows the CBN's injection of $50 million at the investors and exporters window last week, and that's a move that rubbed off on the street market rates. Of course, the resumption of the forex sales to the BDCs today is part of the Apex Bank's efforts to enhance access to hard currencies after the resumption of international flights over the weekend. Now, after a successful issuance of the National Corporate Governance Code early 2019, the Financial Reporting Council of Nigeria is set for another landmark in the trade and investment ecosystem in the country. Currently at the finalization stage of another guideline, the Council has put out an audit regulation that looks to coordinate the activities of registered auditors and their professional duties, and that's in order to earn the trust of foreign and domestic investors. Now, the exposure draft of this audit regulation has been made public for scrutiny, and comments from operators and other concerned bodies will be open until September the 24th, 2020, to avoid controversies that may arise post-implementation. But joining us now to examine the provisions and benefits of the audit regulations is the Deputy Director and the Head Directorate of Accounting Standards for Public Sector at the Financial Reporting Council of Nigeria, Dr. Ihai Anyahara. Good morning, and thank you for joining us on the program.
Good morning. Thanks for having me.
All right. So from the perspective of an international audit firm, tell us, what's the purpose of this audit regulation?
Fine. The purpose of the regulation is to enhance audit quality in Nigeria, which will increase confidence of the public in corporate reporting. And of course, once public has confidence in corporate reporting, we expect that investment will grow and the capital market efficiency will, of course, be there. And generally, foreign direct investment is expected to flow to Nigeria.
Now, what with the audit regulations now, what are some of the critical aspects of auditing that are likely to change? And that's talking about remuneration structures, business sustainability, risk management, and perhaps board-level expertise.
Yeah, other things that are expected to happen is that the auditors are expected to take their job more seriously, because any default, any problem with their job will attract a serious fines and penalty. And that also will increase robust reporting disclosures, both from the auditor perspective and from the company. So the regulation actually bringing a framework that will ensure corporate reporting to the extent comparable globally.
Now, is there any existing guideline that this new audit regulation is coming in to replace? I'm sure many would like to know that.
Well, I would say basically no, because this is the first regulation we're having, what I would call a unified regulation. What we have was self-regulation by different professional accounting organizations like ICANN and ANAN. You know, we have an audit market that is very large in Nigeria. They require a uniform regulation, and that is what the framework is putting in place, so that whether it is a member of ANAN or a member of ICANN, or even when National Assembly deems it fit to bring in a new professional accounting organization, all of them will be using the same framework in carrying out their audit exercise.
Now, I know that the regulation is actually targeting audit firms mainly, but is there anything within this regulation that perhaps boards of public or private companies as well as audit companies need to know about the regulation that's to prevent the type of current situation we now have with the CAMA laws, for instance?
Yeah, what additionally we have in it is prior to this period, audit committees were not totally regulated. And CAMA, the new CAMA has given us a very good leverage to have audit committees properly aligned with audit regulation. So we expect, because they provide assurance, we expect the kind of assurance they provide to be in line with audit regulation.
But for the benefits of some who may not know, what are some of the contents of this regulation?
Some of the contents of the regulation include registration, what it requires an auditor who carries out his professional job after being licensed by the professional accounting organization is required to register with Financial Reporting Council. And it is an offense to carry out or to present yourself for job without being registered with Financial Reporting Council. It also details about audit reporting, it details about monitoring, it details about review that will be carried out in the process of the auditors carrying out their job. So it's an elaborate regulation that is put together by 14-member panel that comprise the Big Four and all the regulatory agencies.
The Big Four?
The Big Four accounting firm. The KPMG, PwC, Deloitte, and Ernst & Young. We constituted a committee of stakeholders who have one thing or the other to do in audit profession to be involved in putting the regulation together. ICANN, ANAN, Office of the Auditor General for the Federation, the Attorney General, all of them were represented in bringing the regulation into place. And remember, we are talking about draft exposure. So, and we are expecting that people are to comment to enable us fine-tune the regulation.
Yes, talking about people's comments now, of course, it's been made public to, attract comments. But do you see any controversies that may arise as a result of the new regulations?
Quite obviously, I don't. Because, like I said, since the entire stakeholders were involved in putting the draft, I see not serious opposition or what, but in any case, there's no way any regulation will come to place without having one or two people expressing reservation. And we believe that the period we have up to 25th September will enable anybody with any grievance, any issue to come together, present the comment so that we can look into it. If the comments will impact on the draft, of course, the committee will go back and look at the comments and incorporate such comments. Otherwise, I see the draft as being a good one.
Well, let's talk more about the content now. Does it change anything in the disclosure program of listed companies?
Yeah, it's going to change a lot in the disclosure of listed companies. But remember, the regulation is not targeted at companies. It's targeted at the work of the auditors. Why it will affect disclosures of both listed and even not listed is it wouldn't be business as usual. The auditors are now going to sit upright and ensure that what ought to be in corporate reporting is there Otherwise, they know that there is a watchdog looking at what they're doing before they may allow such to slip without them knowing. But with the regulation and detailing what the issues are, that will ensure that the listed companies do robust disclosure and what we call in IFRS full disclosure. And we're expecting a better corporate reporting period going forward.
How does this regulation actually align with the Companies and Allied Matters Act and other primary sector regulations?
Fine. The Financial Reporting Council has the statutory responsibility to oversight accounting, auditing, financial reporting, actuarial, even corporate governance. The new CAMA, to my mind, even gives us a good leverage. So there is no issue of any conflict or any issue with the CAMA. And talking about sector regulators, of course, they know that an umbrella regulator in financial reporting is Financial Reporting Council. And let me tell you that the drafters of FRC Act have an elaborate arrangement where all stakeholders in financial reporting come together as members of the board. It's one of the largest board you have, about 23-member board. So any issue relating to financial reporting is usually handled and trashed at the board level, and that minimizes any issue of conflict between sector regulators and Financial Reporting Council. So the regulation per se wouldn't have any controversy between the FRC and sector regulators.
Well, then, with the new CAMA laws, the audit of companies' accounts limited by guarantee is optional in that sense. But is there a parallel between the audits regulation and the CAMA?
Of course, there should be no parallel relationship. What the audit regulation is doing is to even enhance the provisions of CAMA. And remember that when there is a regulation and there is provisions of a law, of course, provisions of the law prevail. What the audit regulation is doing is to enhance the issues relating to the appointment, to the responsibilities and duties of the auditor. It's not in any way contradicting with what the session on audit in CAMA is saying. Rather, we have looked at it. We are quite encouraged by the provisions of CAMA, and we believe that the regulation will rather enhance those provisions.
Now, when everything is fine-tuned now, of course, it's still open to the public for comments now, but when everything is fine-tuned and the regulations actually come into place, what about implementation? How do you ensure, is there any provision to ensure strict enforcement or implementation of the regulations?
Yeah, that's an angle I wouldn't have loved to enter, because once you have regulation, at the back of everybody's mind is sanction. But the regulation is to put everybody to do the right thing. Of course, we have a mechanism, even in our Act, Section 61, that provides how we can monitor the auditors of public interest entities and ensure that they comply with laid down international standard on auditing. So in that perspective, I don't see the monitoring and enforcement of the regulation to be an issue, because we are carrying all the stakeholders along, especially the professional accounting organizations. We are working hand in hand with them, and I'm too sure that even the auditors, by the time we escalate the enlightenment program with all the auditors and the audit profession, issue of non-compliance will be very minimal. And I expect that Nigeria will be far better off in that area.
Of course, yes, you say that issues of non-compliance will be minimal, but will there be sanctions?
Of course, every regulation and every law has provisions of sanction.
So what are some of the sanctions that...
Well, sanction, if you don't comply, we have schedule of sanctions we made as rules that are stated.
All right, so how will the audit regulation promote trade and investment, especially now that the AFCFTA is in the works for African countries?
Fine, that's a very good one. Capital moves to where there is strong discipline. And any jurisdiction that has no strong regulation about its corporate reporting, there is the fear that the investors' fund will not be protected. So with the audit regulation, we are sending signal to international community that we are quite ready to do what is being done globally. And there is this forum, International Forum of Independent Audit Regulators. We have not been able to leverage in that forum because we have not put in place the framework for this audit regulation. And that forum gives a lot of comfort to international investors that we are sure that your investment going through all the regulatory processes will be protected. So that's one of the reasons we considered it absolutely necessary to launch Nigeria into that forum so that we will have the global confidence in our capital market that the regulators have what it takes to check corporate reporting to be what it ought to be.
Well, is the FRC likely to expand the open period of exposure draft beyond September the 25th, especially if new inputs or amendments are required?
If need be, we will. Of course, the exposure period had already been extended. It was intended to end on September 11. But we have discovered that the stakeholders, about 8,000 auditors and assurance providers we have in our database, we decided to extend by 2 weeks. That's why it is up to 25th. However, if we have requests and it is obvious that there is need for more exposure period, we are here for good regulatory practice. We'll be able to extend the period.
But so far, what are the feedbacks that you're getting from concerned parties?
The feedbacks are quite encouraging. The feedback we received, for instance, the webinar we held on Saturday, we had about 916 registrants and about 345 participated. The comments are quite encouraging. The only issue raised is that we should escalate the enlightenment program further so as to get more comments. And this opportunity we are having today at Channel is one of the exercises we are doing in the enlightenment program. And we have lined up a lot of other enlightenment programs that will reach to all zones of the nation to enable us get credible comments.
But prior to now, has there been any form of enlightenment campaign?
Yeah, there is. Like I said, we have a database of about 8,000, and we have emailed the draft exposure to all of them, and we have also reached out our press, both print and electronic, in this aspect. So we are really carrying out a lot in the enlightenment program.
All right, we'd like to thank you, Deputy Director and Head Directorate Accounting Standards for Public Sector, the FRC, Dr. Ihai Anyahara. Thank you for coming on the program.
It's a pleasure. I appreciate it. Thanks.
All right, we'll be analyzing half-year results of banking stocks when we return in just a moment. Don't go away. Welcome back. Now, last week at the stock exchange, the markets witnessed the submission of half-year results from Tier 1 banks that missed the 60-day window for their financial results declaration at the NSE. The lenders include Zenith Bank, Access Bank, UBA, and GT Bank, all of which declared interim dividends eventually, and some from their retained earnings, despite reporting declines in their bottom lines for the period. Now, the delay for their earnings were attributed to late approvals from their primary regulators, the Central Bank of Nigeria as the financial institutions has projected September ending as their filing period. But following the declaration of the half-year figures, however, a mixed bargain hunting and profit-taking took over the last 3 trading sessions that dominated the trading week as investors moved to position themselves for dividends. Joining us now to make sense of these figures is a partner at Gifted Analyst, Mr. Samuel Adebisi, who's right here with us in the studio. Good morning, Adebisi. Thanks, Mr. Adebisi. Thank you for coming on the program. Well, what do you think could have held back these banks' results with the CBN for so long, to the extent that they missed the 60-day filing period of the stock exchange?
Well, COVID-19 is a once-in-a-century event. And due to this, the CBN needs to reassess the banks, needs to check their ability to pay dividend, check if there are things that needs to be tightened, check if there are policies that needs to be put in place before they put out the result. One of those things that they need to check also is the ability to pay dividend. Try to run many scenarios, sensitivity analysis. What if profitability declines by 50% due to COVID? Will the retained earnings still be strong enough to make them operate? Do we need to recapitalize these banks? So these are things that the CBN needs to consider, and this is not something that we have experienced before in the past 100 years. So it requires a new method. It requires some time for the CBN to access this. So that's why we see these banks not making up the 60 days period.
Well, then, generally, what does the release of these Tier 1 names contribute to the markets?
Well, there are some interesting insights from here. One is the impairment. Impairments were about over the roof, but understandably, because this is a time where the COVID-19, we expect impairment to be high because some of their customers are not operating at their full level. They also will not be operating at their full level. So because of this, impairments are expected to be high. But however, I would like to put a benchmark of 100%. Any impairment charge over 100% means that there's something else that is pushing it beyond 100%. So apart from impairment, also we see all these volumes growing during this period in terms of net interest, non-interest income. Volumes are growing because these banks are trying to launch the digital platforms in a time where people cannot be together. People are trying to look for alternatives to cash. So in this period, they're able to grow volume. But looking at fees and commission income, they weren't as buoyant as we expect for a time where volumes were growing. And this all because at a time like this, the CBN decided to clamp down on the charges on electronic transfers around January. So because of something like this, for the likes of GT Bank, who have a lot of retail customers who transfer even below 50,000 naira, they will be impacted because of the fee they have to charge on it. That's how we see the likes of GT Bank recording 34% decline in this area. So these are interesting things that we've seen in this period from these banks.
Now, let's also talk about dividends. Now, we saw all the banks ending up recommending dividends to shareholders, despite some of them posting declines in profits. Of course, one would have thought that they'll heed to the advice of the IMF MD, who had suggested that banks shouldn't pay dividends during this period of the COVID-19 pandemic, of course, to boost their retained earnings for the survival. So how come we saw them declaring dividends still?
What the IMF says is general intelligence. It's only natural for us to think that, oh, this is a time for you to strengthen your buffer in case this is supposed to go longer than we expected. But it's case specific. Looking at Nigeria, some of these banks, given their performance, some of these banks have retained earnings that can pay some years of dividend if they maintain their profitability level, or if the profitability level is not as low as minus 50%. So looking at these scenarios, I'm very sure this is one of the things the CBN considered before they let them release the results and why this result took long before it was being released. So they are at a position where at least for this year, they can be able to pay that dividend and pay dividends. And we are seeing the economy trying to open up, which means that their customers are trying to do more transactions. The customers are trying to open up. In terms of impairment, we see them might be coming back to say, okay, you know what I mean, I'm open for business now, so I can pay you the money I'm owing you. So looking at all these things together, it seems that they are at a comfortable position where they can pay dividend, at least for this interim period, and probably for the full year.
Now, let's go bank specific now, beginning with Zenith Bank that has its macroprudential ratio settling within statutory limits. Was that performance beyond expectations considering the impact of the pandemic?
The performance was decent. The macroprudential ratios, the NPL ratio kept within limit. The CAR, the liquidity ratio, so there are things that we do not expect this we don't expect this to be bad. We expect this to happen. So that's not the main thing. Looking at other key ratios like the cost of fund trickling down to 2.2%. But then looking at things like your NIM also improving to 9%. This is awesome. However, there are other things to look at. Impairment charges increasing by 74%. This is something to be bothered about. However, I gave a key that in this pandemic, if your impairment cost is not more than 100%, I think this makes sense. We can give you that slack that, okay, this is because of this. So I think this is a very decent result. The only thing to think about is that the impairment has to be, they need to think about how to go about this impairment, how to make sure that as the economy is opening up, they're able to recover this loans, they're able to write back these impairment losses. So decent result from Zenith Bank. The only thing that was more than that was beyond expectation was the way they were able to record growth in PAT because of tax expenses.
Yes, let me talk about that tax expenses. Now, I was just going to ask you what role the reduced tax expenses played in the expansion of Zenith Bank's profits.
First, this is unprecedented. We didn't expect this to happen. Like, after your PBT only grew by 2%, you were able to reduce your tax expenses by 54%. But observing the tax expenses, we saw that dividend tax last year was 15 billion. This year, there was no record of dividend tax. So the assumption is to think that maybe they were able to defer the dividend payment for this year, or they were able to take it away from, because of the period they announced the dividend, we did not fall between the H1 period. Maybe they were able to defer it to next one. But however, this is something that I know a lot of analysts are waiting to hear from them that, okay, how are you able to do this? And other banks are not able to do it, or they did not choose to do it.
Now, let's shift our attention to GT Bank. Now, what are your takeaways from the result in spite of the relative decline in earnings? Was that decline actually expected?
For GT Bank, as we're running the treadmill, we always expect them to grow revenue. For them, we expect that, okay, maybe you grow your top line and bottom line mildly, let's say some strong single digits, something like that. We didn't expect that, but then we know that this is a period where they didn't expect. First thing is looking at their fees and commission. Fees and commission declined by 34%. And it's majorly because, this is a period we expect that, they should grow volume. People should seek alternatives to cash and all. However, because they have a lot of their customers as retail customers, that means that a lot of them will be doing below 50,000 naira in transactions. That means that the charges they're going to get on this will be significantly low. Despite the growing volume, the fees and commission reduced by 34%. So that's one thing to note in there. And also, looking at the, apart from fees and commission, looking at their cost-to-income ratio, they have cost leadership in this industry. We saw cost-to-income ratio rise above 40% to 43%. So this is something that we think they need to focus on and try to look at how to drive down costs, because we know them for cost leadership in this industry.
But do you think the increase in marketing expenses as well as statutory charges like that of AMCON and NDIC fees have anything to do with these declines as well?
Well, if we were to pick all these things by one, we could also say, could it be that if the yield on earnings assets were some basis points higher, would they have been able to record profit? If the impairment charges were not above 200%, would they have been able to record more profit? If the operation expenses were a little lower, would they have been able? So there are many scenarios that we can bring together to play to. So it's not necessarily AMCON fee, not necessarily marketing fee. In fact, I think this is a time where, as a bank, this unprecedented time in history is a time where you can come out and show that and grow your brand equity. And I think GT Bank has done this during this time. So all those ones have been helping them to grow their brand equity. And I think this is outstanding. So it's not really about that. It's a whole lot of things together. Not just about the AMCON fee, the marketing fee.
Now, as for Access Bank, we saw operating expenses increase substantially in H1 by about 40% to 174 billion, given the effects of the consolidation with Diamond Bank. But does that in any way explain the marginal decline in profitability?
To a large extent, yes. Because given the merger, one thing we would expect from a merger is cost synergy. the fact that both of you are able to come together, able to share resources, and sharing resources means that you're able to keep down your cost. So when your cost is growing at over 40% and your gross earnings is growing by 22%, it shows that there's something in between that needs to be more efficient. So this shows that there's a need for the bank to look inward and try to clamp down on rising costs. There's need to focus on these things. They need to clamp down on rising costs. Not only this, there's also the need to reshuffle their assets going forward, reshuffle their interest earning assets so that they can be able to grow the top line much more than they are doing now. I mean, I think that apart from you just growing your top line, there's also need to clamp down on costs. Cost running 40%, revenue running 22% means that there's room for efficiency in that aspect.
Now, just before I let you go, let's talk about UBA. Of course, UBA had a weaker performance for the period. Any idea what actually reduced their output?
First, the results was underwhelming, and looking at it, it's majorly about their OPEX. OPEX increased a lot. It was not expected. The interest income was weak, and all these things coming together, it all boils down to cost. What I would expect to see from UBA this period is to reshuffle their interest earning assets. When they do this, then also to clamp down on costs, the operations cost of the company. So clamping down operations costs and also trying to reshuffle their interest earning assets so as to earn more interest in this period are things that I would like to focus and like them to see in this period from UBA.
Now, but how much scope of gains for net interest income growth do these banks actually have for the rest of the year, considering the reviewed minimum rate on savings deposits of 10% of the MPR, which the CBN just issued last week?
Also, I think this is a policy that was born out of the 60 days period where the CBN chose to look at this, to reassess these banks. And I think it's impressive, given that the yield environment is lower, it only makes sense for them to cut down the savings rate from 30% of MPR to 10% of MPR. So I think this will help the banks to lower their cost of fund, which there's something they're trying to work on before. This will help some banks to lower their cost of fund, try to increase the net interest margin. This is something in the right direction for the banks and also for the economy, for people to put more money into investment, put more money into the economy instead of trying to save it.
Well, going forward now, where do you see the core income for these lenders, given the investment security space is not so beneficial for the institutions anymore?
Well, for banks, you just have to look for a way to deploy your fund. We know that the CR was increased by 5 basis points. The policies are all coming in. You just have to find a way to deploy your funds. So one thing I would like to see them do is they need to grow more deposits. If the CBN is taking 27.5%, and sometimes the discretionary CRR comes into play and the CBN just looks at your liquidity and I'm like, you have a lot of liquidity, I want to debit you. That means that you need to grow your deposits more rapidly so that you can grow your interest earning assets, you can grow your interest income. This is something I'll be looking forward to. And also in part of the non-interest income, I would love to see these banks come together and try to grow transaction volumes. I mean, this is a period where we see people have the tendency to move away from cash to mobile payments and things like that. I would love to see the banks put more energy into it and try to grow volume, despite the fact that the rates on electronic transfer has been reduced. I'd like to see them grow volumes.
All right, partner and gifted analyst, Mr. Samuel Adebisi, thank you for coming on the program this morning.
Thank you.
Now, let's just do a quick recap of activities at the crude oil market this morning. Of course, we've seen prices down more than 1% today after they earlier hit their lowest since July. And this is coming as Saudi Arabia made the deepest monthly price cuts for supply to Asia in 5 months, while optimism about demand recovery cooled amid the coronavirus pandemic. Brent crude was at $42.18 a barrel after earlier sliding to the lowest since July the 30th. US WTI crude was also down to $39.26 a barrel after earlier dropping to their lowest since July the 10th. The world remains awash with crude and fuel despite supply cuts by OPEC Plus and government efforts to stimulate the global economy and oil demand. Refiners have reduced their fuel output as a result, causing oil producers such as Saudi Arabia to cut prices to offset the falling crude demand. Oil is also under pressure as U.S. companies increase their drilling for new supply after the recent recovery in oil prices. Well, let's also remind you that the Central Bank of Nigeria will today resume the sale of foreign exchange to Bureau de Change operators nationwide, and that's a move that is expected to further strengthen the exchange rate of the naira. The regulator had issued a notice earlier stating plans to resume the bi-weekly sale of $10,000 per operator from today. At the parallel market last week, we saw the naira closing at around 430 naira to a dollar, compared to 480 a week earlier. And this also follows the CBN's injection of $50 million at the investors and exporters window last week. And that move rubbed off on the street markets rates. The resumption of FX sales to the BDCs today is part of the Apex Bank's efforts to enhance access to hard currencies after the resumption of international flights over the weekend. Now let's get a review of last week's trading activities at the Nigerian equities markets with Edidiong Iwan. Good morning, Eddie. Let's have the numbers.
Good morning, BC. Well, while most global markets closed either mixed or lower last week, the market in Nigeria saw a higher level of activity from both local and foreign investors, and that was largely due to Tier 1 banks. The all-share index rose 1.17% to 25,605.64 points. I'd like to point out that that's the highest level we have gotten to since March. The equity cap was also at 13.358 trillion naira. Volume, value, and deals traded last week were higher compared to the previous week, as we saw 2.20 billion units worth 10.95 billion naira, all traded in 18,013 deals. The banking sector was up 2.78%. Of course, that was due to GT Bank, Stanbic Bank, UBA, Zenith, and Access Bank. Consumer goods was up 1.49%. Industrial goods gained 0.44%. Insurance was up 1.96%, while oil and gas jumped 3.65%. But let's talk to Afolabi Benro, a trader at Stanbic IBTC Bank, for more. Good morning, Afolabi. Thank you for joining us on the program.
Good morning. Thank you for having me.
Well, we've seen steady gains in the market lately. How long do you think that these gains will be sustained?
So last week, the gains that we saw were basically on the back of anticipation of the half-year results that investors had been expecting. Most of these numbers were going to be audited, so it took a while for them to be released. So we started seeing them come into the market from the 1st of September. We saw Access Bank, GTB, Stanbic, UBA, Zenith Bank, and Fidelity release results, and this excited investors, especially because quite a number of them declared interim dividends. So we think that the momentum might be sustained, maybe into the earlier part of this week. Yes, we expect that the momentum will be sustained into the earlier parts of this week, as we've already started seeing in the market in the trading session today.
Well, apart from the banking sector and the big banking names, what else should we be expecting from the market this week?
So activities have mostly been driven by sort of cross-transactions, block transactions, where a buyer and a seller speak off market and then they come to the market to execute. So we saw, for example, in Nigerian bills that the prices, also appreciated on the back of some of these cross-transactions. So we expect that this will probably continue in the market as well this week.
Can you tell us how the market has started today? What is driving the market at this time?
So it's mostly locals that have been driving activities. We've been seeing, buying interest, like I mentioned earlier, on the back of the anticipation of the results released into the market. So the session has started, with an uptick. We're seeing, interest in the banking names again, and we expect this to probably continue throughout the session.
Thank you, Afolabi, for your input on the program. Afolabi Benro is a trader at Stanbic IBTC Stockbrokers. We'll have to leave it there for now. Over to you, BC.
All right, Edidiong, we'll come back to you in just a moment for the debt and currencies market. And then we'll also see what's happening at the London markets when we return in just a moment. Please stay with us. Now, let's cross over to the UK to know what major headlines are trending this morning. Good morning, Juliana Olayinka. Thank you for joining us. Now, let's begin with Brexit. The ministers are planning a new legislation that would override a key part of last year's EU withdrawal agreement. But then PM Boris Johnson is expected to say later that if no agreement is reached by October the 15th, both sides should move on. What exactly does this mean?
Good morning, Bissy. Well, what that would mean is that there would be no deal and Britain would fall out of the EU under World Trade Organization terms. But we're not certain if that's going to be the case. But everything is leading to that suggestion, and we're expected to hear from Prime Minister Boris Johnson later today. His chief Brexit negotiator, David Frost, over the past couple of weeks has been a little bit honest and forthcoming about this, saying that they do want to go for an agreement, but they are not afraid to walk away. And it appears as if, to the fury of opposition party members and perhaps some backbenchers in his own party, Boris Johnson will stick to that pledge. When it comes to the withdrawal agreement, this all centres on the Northern Ireland Protocol. Now, for the past 3.5 years, the island of Ireland has been a major sticking point, which has caused problems with negotiating because, of course, Northern Ireland is part of the United Kingdom. Ireland is part of Europe. There is no border between the two countries at the moment. And as part of the withdrawal agreement, Boris Johnson, to the surprise of Northern Ireland, did agree to allow certain parts of Northern Ireland to remain aligned with EU rules and regulations. Now, according to the Financial Times over the weekend, this part of this agreement will be ripped up. We're expecting to hear more later this week. The 8th round of Brexit negotiations will kick off tomorrow. And because Prime Minister Boris Johnson is expected to pull away from that historic agreement, because we know that Ireland, the island of Ireland over the past decades have faced serious troubles, and they wouldn't want that to be heightened again, which is why there will be surprises and eyebrows raised from both sides of the border if Boris Johnson does indeed step back and rip up that protocol.
The UK's foremost manufacturing group, Make UK, is joining calls for the government to change its mind about ending the coronavirus job retention scheme in the autumn. And that's after a survey of its members showed almost 62% of companies agreed with the proposals that the scheme be extended. With all of these calls now, are we likely to see the government bow to pressure?
I think we discussed this, didn't we, last week? I think the government have been pretty clear on their position. In fact, I do have a statement from a government spokesperson, which I'll read to you. They said this morning, by the time it closes, the furlough scheme would have been open for 8 months and helped to pay the wages of over 9.6 million jobs. I think the crucial part is in this sentence. While we can't sustain this situation indefinitely, we are continuing to support people and businesses through our plan for jobs. For businesses that can bring furloughed employees back to work, this includes a £1,000 retention bonus. We're also creating new roles for young people with our Kickstart programme. That's exactly the comment that Prime Minister Boris Johnson made last Wednesday in the House of Commons during PMQs. But you're right, you know, there have been growing calls. Made UK are just one of them. They represent the manufacturing industry, and they spoke to over 200 businesses. And in their survey, the majority of those businesses said they wanted the furlough scheme to keep running. They're very worried, as I suppose the entire country is worried, that as soon as this furlough scheme comes to an end, then there will be mass redundancies. However, I think the government have been asked this question time and time again, and they seem to be sticking with exactly the same statement, which is why I thought it was important I read that out to you now, as well as Andrew Bailey, the Bank of England governor. He also says that it's unsustainable. It has cost, I believe, at the moment, over £35.4 billion, and that isn't coming from the government's purse. The taxpayer is going to have to pay that back. So there are fears, there are concerns, not just in Britain, across the entire world, of how much this COVID pandemic has cost the society. But the government's line is exactly what I've stated, that at the moment there are no plans to extend this scheme.
All right, Juliana, it's a brand new week. Tell us what to expect.
Well, of course, Brexit is going to be the top of the list. I believe Boris Johnson will say later today that October the 15th is the do or die deadline. No deal, we're out on World Trade Organization standards. Michel Barnier, the chief Brexit negotiator, will be in London tomorrow, so I'm sure there'll be some interesting sound bites coming out of Downing Street. The FTSE 100 opened up higher this morning. The pharmaceutical industry seemed to be propping that up, as well as Associated British Foods. Associated British Foods are the umbrella company, the owner of Primark, and they announced that they've seen a much higher than expected footfall in their stores since the pandemic. Of course, they've got a quite unique position of not being online. So whereas most retail stores were able to sustain themselves during the pandemic because of online sales, Primark didn't have that, but they said that baskets have been much higher than typical, so their shares rallied and they were up about 6% at early trading. The pound is lower against the EU and the dollar, and that's because of that FT report about Boris Johnson changing the Northern Ireland Protocol. But this week, Brexit is back in the spotlight once again.
All right, Juliana, thank you. We'll see you again in the afternoon.
Thank you.
And it's back to you, Eddie Young.
Thank you, BC. Well, the unlisted securities market was positive last week by 0.43% to 714.21 points, while the market cap rose to 524.64 billion naira. We saw about 75,289 deals, units worth 5.48 million naira traded in 21 deals. The bond market was relatively quiet last week as the market traded sideways. Now, we saw mixed sentiments across the board as local PFAs are still avoiding or resisting the current yield levels. On Friday, we had 35 deals worth 13.55 billion naira. Same thing at the Nigerian Treasury bills market. That market was quiet last week. We had just 8 deals on Friday worth 330.96 million naira, while there were 72 deals at the Omo market on Friday worth 101.47 billion naira. Well, joining me now to talk more about the fixed income market is Constance Onya, a fixed income dealer at Access Bank. Good morning, Constance. Thank you for joining us on the program.
Good morning. Thank you for having me.
So the bond market, we saw a lot of mixed sentiments at that market last week. Is that likely to continue this week?
Okay, so we continue to see mixed sentiments in the market. We saw slight bullish sentiments on the 2049 bonds and 2050 bonds. We saw rate go as high as 10% levels, and then people started taking advantage at that level. But this week, we also expect that we'll have mixed sentiments, and then slight bullish sentiment is expected in the market as the market is liquid at over 700 billion coming into this week. We also expect primary auction on Wednesday, where the NTB 128 billion will be rolled over. Okay, so we have 148 billion maturing, but 128 billion will be rolled over for the NTB auction for Wednesday. We expect the 91, 182 days and 364 days to be on offer on Wednesday. And on Thursday, we have about 250 billion OMO maturity coming into the system, where the CBN is expected to conduct an OMO auction for Thursday, even though they might not mop up the whole liquidity in the system. We might just have about 100 billion being mopped out, and then maybe CRL debits across the banks to reduce the liquidity in the system.
All right, Constance, thank you for that wrap-up of the market. Constance Onya is a fixed income dealer at Access Bank. We'll have to leave you there on the market review for today. Over to you, BC.
All right, Eddie, thank you. And we'll hope for a profitable trading week. And that's where we wrap up today's program. Thank you for watching. I am BC Adebayo.